Everyone is saying that the stock market is due for a correction, but when is this correction coming? And in the recent Evergrande saga, the stock market tumbled and it fell a bit. Is this a correction that we are looking for? So in today's video, we're going to talk about some of these strategies that I've been holding close to my heart and I still use it till current date. So when you first start investing, one of the most important concepts to understand is to dollar cost average. So what is dollar cost averaging and why should you dollar cost average? What dollar cost averaging does is it instills a habit in the investor to constantly put money into the market regardless of market sentiment. And by constantly adding positions on a regular basis, it allows us to accumulate assets and grow our portfolio. On top of that, if you're accumulating dividend stocks, this gives you the benefit of using your dividends to buy even more stock as time goes by. So to start dollar cost averaging is pretty simple. We just need to decide the asset that we want to hold and how much we are looking to purchase on a monthly basis. And once that is done, purchases are done every single month regardless of market movement, and this will eventually build a habit of constantly putting money aside and investing for your future. But before we continue with the video, I want to thank today's sponsor, which is 1Market. 1Market is a broker that allows you to trade ETF, commodities, currencies, and stocks. They have 6 types of account available, from a mini account all the way to a professional account. And each type of account provides a different benefit and feature that can help you with your investing journey. So one of the key features that I like with 1Market is the zero fee stocks. You're able to trade stocks like Apple, Amazon, Netflix, Zoom, Coca-Cola, and much more on the platform. On top of that, they do offer leverages as well, which means that you can purchase more with a smaller sum of money. Signing up for an account is simple, easy, and fast. Just visit the link in the description down below and you can get started with 1Market. So once you complete a sign up, you're able to view the different kind of assets available on 1Market, and you can filter them by assets that you want to trade, and it provides you information that is critical to your decision in buying. So one piece of information which I think is interesting to have is the crowd sentiment. It tells you the current buying and selling sentiment of the market, and this allows you to make informed decisions on your purchases. To find out more about what 1Market does, you can sign up with the link in the description down below. And once again, thank you 1Market for sponsoring today's video. So the second thing I learned is to buy blue chip stocks. I kind of avoid penny stocks or very speculative stocks altogether because to me, my stocks are going to be my retirement fund. I'm building it month by month to grow it into a sum that will enable me to retire comfortably. But then some might say like,
"Hey Jordan, blue chip stocks are so expensive to buy or to own, how can we even do it?"
So as mentioned in the previous point, we don't have to buy huge amounts of it at once. We can start buying small amounts and grow that portfolio from there. On a side note, it's worth noting that anything that is great requires time to build, and constantly hoping to become a millionaire overnight is almost as good as just gambling. And therefore, that is why I stick to purchasing blue chip stocks, because they are relatively stable and reliable in growing over a long period of time. So what if I want to grow my portfolio at a faster rate, but I would like to take a little bit more risk but still be relatively safe? So for the growth portion of my portfolio, I go with ETFs. For those of you that have no idea what an ETF is, ETFs are exchange traded funds. So exchange traded funds are a group or a basket of stocks that tracks an underlying index. There are many ETFs available out there that have potential to grow your portfolio at a much faster pace. And the beauty of an ETF is enabling you to own small amounts of company with the purchase of only one ETF. For example, if you're looking at tech stocks, QQQ can be an ETF to consider. By buying QQQ, you own a little bit of Apple, Microsoft, Amazon, Google, Tesla, Facebook, PayPal, and many more. And as a tech-heavy ETF, this gives your portfolio exposure to the tech giants of the world. But instead of purchasing all these individual stocks, you can purchase QQQ to own a little bit of these giants. And it saves you a lot of money as well.
Save money?
Absolutely.
And the price difference between owning an ETF and those individual stocks is like paying $300 versus thousands and thousands of dollars if you were to buy each of these tech giants. But always remember that with higher growth comes with higher risk as well. Or maybe you're the kind that prefer to track the whole US market. You can consider something like VTI, which tracks the whole US market, and this might be a good option for those who are looking to have exposure to the US stocks but are unsure what stocks to purchase. So the top 10 holdings of VTI includes Apple, Amazon, Microsoft, Google, Facebook, Berkshire Hathaway, and JP Morgan. So these are pretty big companies, or probably the largest kind of companies in the world, and therefore by buying an ETF like VTI enables you to get exposure to these companies as well. So these are the 3 lessons that I learned when I first started investing. And once again, I'd like to thank 1Market for sponsoring today's video. Do check them out. I'll leave a link in the description down below. And that's the end of today's video. Do drop a like if you haven't, subscribe, and I'll see you in the next video.